how bad does it get for energy stocks?
Well, I think the energy sector has to change its business strategy. If it continues the way it's been going, we've already had a lost decade, as you pointed out from the charts. And the sector's at risk of doing the same thing again unless that actually changes the way it runs the business.
So at this point, like regardless of the activism, which we will get to, can these companies have any cash flow to cover their dividend at 47, 46? Like what's the super pain threshold?
Well, I think below $50 a barrel, it's very hard to find any economic wells being drilled in the US. There may be individual ones, but certainly from a company standpoint, no company is returning their cost of capital today at this commodity price environment.
And if you take a look at this chart, it shows sort of the XOP versus the S&P and how much they've underperformed just in the last year. If you go back further, it's even worse. What do you suggest they do to fix it if you have an oil price at 47, 46?
Sure. I mean, look, fundamentally, this business doesn't have a cash generation problem. It has a cash use problem. You know, all of these E&P companies are taking their cash, they're borrowing money at 9, 10% cost of capital, and they're reinvesting it in the ground and generating a 1 to 2% return on capital employed. That's fundamentally unsustainable. Our view is the sector's got to start returning cash to shareholders. It's got to lower its reinvestment rate towards 60, 70%, closer to where the S&P average is, and it's got to return that cash to shareholders. If you can return the enterprise value of a company within 10 years in dividends, then you should see people come back to this sector.
And this is sort of like your playbook of what you should wind up doing. And I guess at $47, $46, even if a company was interested in talking to you, could they really execute?
It's definitely hard. There's definitely costs you have to cut. You have to become more disciplined on the wells you're drilling. You have to high grade your portfolio, lower your SG&A. But it is possible if you have the highest quality rock. Realistically, the names we're looking at are names at the front end of the cost curve in the best basins with the best rocks. There's a large portion of this industry that's unsustainable and can't make the economics work. And frankly, that portion of the industry just has to go away.
Is there an oil price on the up or downside where this thesis of yours you think holds less ability to execute?
Well, what we've seen from previous campaigns is if the commodity price rallies, management teams become less inclined to change.
They say they're changing that behavior now.
They do, and look, we've seen incremental steps. We've seen people talk about paying dividends, but you're talking about a 1.5% dividend yield. We're talking about companies paying 10%, 12% dividend yields, returning 100% of the enterprise value within a decade. Then the optionality on the long-term outlook for a commodity, investors are willing to take that risk. But that's what they need to do to bring investors back to the sector, and we saw it in refining and tobacco.
So tell me more about that.
Well, I think if you look at the refining sector, people believe there was no growth in US gasoline consumption, and that thesis has held true. When you look at it, US refiners said we're going to stop reinvesting in new capacity and cokers and new expansions, and we're going to take our cash and return it back to shareholders. And it's been one of the better performing sectors in energy, and it's outperformed the S&P.
So then when you take that model and then look at the energy stocks, where are you going to start? Like, you're start the small companies? Like, do you go into for the bigger companies and try and be more of an activist there? Like, what's your strategy?
Well, the interesting thing in the sector is a lot more names have become, within the range of names that we could go after because of the drop in market caps. The reality is we don't want over-leveraged names. If you have leverage of more than 2.5 times EBITDA, it's very difficult to change anything within that business model.
Just ask Chesapeake.
Yeah, we want companies with high-quality assets at the front end of the cost curve with bloated SG&A. But look, the reality is 80% of the industry has these issues, and it's going to take a long time to change it, but there's a lot of targets to go after.
Now, when you mentioned sort of how much they wind up reinvesting, now someone would say, well, they have to reinvest that much because they have to wind up producing more oil to offset the decline rates in the existing oil fields. They have to do that. And I know that if you look at the other sectors within the S&P, they outspend much more. But what's wrong with that argument?
Well, look, fundamentally, if I borrow money at 10% from a bank and I took it and invested in US Treasuries and earned 1%, most people would stop giving me money. But that's been the E&P business for the last decade. What we're saying is if you have a portfolio, you shouldn't model your portfolio on trying to hold production flat. You should look at your wells, decide which ones actually make a return, and only invest in those wells. And the truth is, for a number of these companies, that'll mean production declines. It may be a modest decline, it may be a steep decline, but that you return the excess cash to shareholders. There's E&Ps now trading at 2.5 times EBITDA, where the most economical thing they can do is stop drilling and just return all the cash back to shareholders.
Can you give me an example of a company that you've done this with that works or that you're looking at, or the type of company?
Well, look, a great example is PDC in our previous campaign, which unfortunately we were unsuccessful for. When you look at PDC, they merged with SRC. They've cut costs, I would argue not nearly enough on the SG&A side. They're still running around 200 million. They've started to generate free cash flow. Last night, the company's talking about a 12% free cash flow yield. But the critical problem with the company is that free cash flow yield is not turning into a dividend to investors. And the risk investors have is that the existing management team will take that cash and just buy something else, which has been the industry problem.